You know, they say that the first 10 seconds of a YouTube video are the most important, but before the 10 seconds ends, let me show you the mortgage I paid off in 2 years and 9 months. There it is. And there we've passed 10 seconds. Anyways, I have made so many of these debt payoff videos that I totally forget that there are people who've never watched my channel. In fact, if I actually look at my YouTube channel analytics and ask the YouTube AI bot right here, there's this little cool Ask Studio AI bot. I asked how many new viewers did I reach, and then we have 640 new viewers in the last 28 days. And so, if you don't know who I am, I actually did pay off a mortgage in 2 years and 9 months, and that's pretty much my Al Bundy 4 touchdowns in one game moment. If you remember the series Married with Children, it was like 4 touchdowns in one game, and I used to laugh. And you know what's funny about Married with Children? You know, say what you want about Al Bundy, but that was a man who loved his family, and that's not something you can say a lot about like your average person nowadays. You know what I mean? Okay, so let's go ahead and get started with this thing called the velocity method, formerly known as Prince, actually formerly known as velocity banking before the state of Illinois started to send cease and desist letters to another YouTuber about this strategy for debt payoff. And then here's another hook that I've been using for a little bit, and it's actually increased my retention time. Where I talk about, hey, let me show you how I turned $0 to 5,000 without making more. Did that too, but today's 10-second hook will be I paid off my mortgage in 2 years and 9 months, and possibly 4 touchdowns in one game. Yes. So if you don't know who I am, you are literally listening to someone who paid off a mortgage in 2 years and 9 months, and possibly had 4 touchdowns in one game, possibly. Okay, so now this is what we're gonna do. So we're gonna pay off debt, and there's two ways of doing it. There's the average American way, and then there's what we call the velocity method, which we like to show pretty much every single video. It's what I do, and I literally forget that there are new people who come to watch this channel. I think it's because I'm in a room by myself saying the same thing over and over again, almost on autopilot. Like I totally forget. But let's just kind of do this, right? And I'm going to demonstrate the way that I normally do when I'm in front of people in real life, right? So I just say this. Listen, let's say, sir, madame, you make good money, but you have nothing left over at the end of the month. And the reason why you have nothing left over at the end of the month is because you have 10 credit cards. It's $167,000 worth of credit card debt. You have an auto loan. You have a modest mortgage. And on top of that, you have personal expenses you have to pay for, food, gas, insurance, which are on average about $2,000 a month. Okay? You have literally $0 left over and $167,000 of credit card debt. Do you need to make more money to get out of this hole? And just so think about that. It's like a couple seconds. Everybody you know will tell you yes, right? I need to make more money to get out of this hole. So what we're going to do is show that if we redirect the flow of money, this zero can magically turn to over $5,000. And that's the clickbait hook for the day. Actually, that wasn't the clickbait hook. The clickbait hook of the day was I paid off my mortgage in 2 years and 9 months. Did I say that enough? I don't know. But I wish I had 4 touchdowns in one game. Okay, so now what we're going to do is we're going to rank our debts using a formula called the cash flow index, which is the statement balance of the debt divided by the monthly payment. And we're going to do that for all of our debts. Why do we do that? Is because it tells us the order which to pay our debt. And the lower the number, that's the one we want to pay off first because we get more bang for our buck in terms of cash flow for paying off the debt. Whereas here, this big number, this 30-year mortgage, what does that mean? Is we pay a big amount for itty bitty cash flow. $300,000 for only $1,400 of cash flow, right? Versus, let's say we pay these two credit cards $40,000 for about $2,000, even more than $2,000 of cash flow. So how much do you want of cash flow per the debt, right? Bang for your buck, okay? So one other thing we're going to assume is that we have a line of credit. So what's a line of credit? It's basically a financial tool where you can borrow money, pay it back, and then use it over and over again. Line of credit. Okay, and so if you don't know what a line of credit is, you probably have one. It's called a credit card, but it's more of a I don't want to say restricted or neutered form of line of credit, but it could be a neutered form of line of credit because you can't use a credit card to pay a loan, or it's really hard, or you gotta use plastique.com, right? And they'll charge you a 2.5% fee, I think, or it might be a little bit higher than that, and then you got to use credit card off, rewards points to offset that, hopefully. And you probably can't use an Amex to pay a loan, right? So all these restrictions. But if you use a personal or a home equity line of credit, okay, personal or home equity line of credit, you can just click a button on the bank's website and they'll dump cash up to a certain amount. So for this demonstration, any free demonstration I do, I always like to demonstrate a free and clear line of credit because it's really easy to see the benefits of knowing the strategy, right? And if you don't know, I'll tell you the secret to getting any sort of credit: loans, lines of credit, HELOC, home equity line of credit. The secret to getting credit is that banks don't lend money to people who need it. And if you didn't know, the reason for that is because banks don't think you're a bad person for needing money. When a bank sees a person who needs money, they think that person's not going to pay me back, so therefore that person is bad. Because the bank has many, many years of institutional experience, and the institutional experience says people who need money don't pay you back. So that's why the bank thinks you're a bad person. So there's a little bit of unrealisticness for this demonstration, but you'll get to see the benefits here. And so what we're going to do is get these low cash flow index numbers, transfer the debt, and see how much our cash flow can increase. And if you want to see how much this is, this 7, 10, 35, 12, 18, and I'm going to go ahead and sum up that credit card debt. So that's $167,000 of credit card debt. So let's go ahead and move that into a home equity line of credit. So think of this as a balance transfer that you do with a credit card almost, but it's not because it's a home equity line of credit. And when we transfer debt, don't the payments go away? 0, 0, 0, 0, 0, 0, 0, 0. And then now I want you to stare at this. I want you to show your friends. Same income, but magically this zero turns into $5,160.71. And we didn't make more money. And we could have done it in an instant, right? So what's the real secret between the average American method versus the velocity method? Well, the way that the average American treats their checking or savings account is the final destination of your money. And then here in the velocity banking, I can't say banking, sorry, force of habit. But in the velocity method, okay, I'm going to tell you that we treat our line of credit as the final destination of money. So money goes into the checking account, and then we just make an overpayment into the line of credit. And so what we do is we put this entire $9,078.11 into the line of credit, take our expenses out, and then rinse and repeat over and over again. So after every single month, the balance goes down by $5,160.71, right? So now what we do is we put our paycheck here, take our expenses out, and then after every single month, the balance should go down by $5,000. So let's go ahead and do this. Minus 5160.71. And then for using the line of credit, we just have to take the average daily balance, multiply it by the interest rate, and then divide by 12. Because remember, that 8% that they quoted you is an annual interest rate, and we want the monthly interest rate. Okay? So the monthly interest rate is divided by 12. And so now we see that the $1,000 is the interest. And usually, if you have a home equity line of credit, you just need to pay the interest in order to keep using the line of credit so that they don't foreclose on your house, right? But with this here, right here, $9,078, if we just dump it into the line of credit, we're always going to satisfy that minimum interest payment, right? So let's go ahead and paycheck in, expenses out, check in, expenses out. Look, the balance is going down, and the interest that I pay is gradually going down. And look how easy that is. Oh my goodness, that is easy. I cannot believe it. I cannot believe it's butter. This is possibly better than 4 touchdowns in one game. 4 touchdowns in one game. Okay? All right. So now in 37 months, we paid off all the credit card debt. So now we got to keep this as a milestone. So 37 months. And then how much is $167,000 of credit card debt? 167K. Okay. And I'm going to go ahead and copy and paste. And then now we have these two other loans, right? And so what loans are they? It's oh, I screwed up here. $300,000 at 4%. Okay. The payment amounts are correct, or they should be correct. Yeah, they should be correct. I just modified this for a previous demonstration. And we are month 37, and then we see that these are the current balances of the auto loan and the mortgage, and then this is the current cash flow index. Okay. So a lot of times people will focus on the interest rate and say, hey, I'm going to spend all of my money into this 4% loan because it's the highest interest rate here. Whereas what we're going to do is focus on the cash flow. So I pay 10 grand, I get about $400, right? Whereas here, I have to pay $283,000 in order to get 1400. And so that's why this cash flow index is so big, because you have to pay a lot to get an iterated amount of cash flow in a relative sense. So let's go ahead and move this loan into a line of credit. So I'm going to do this plus 10830.66. And then what we're going to do is this is going to be 0. We get an extra $400 in our cash flow. And then this is going to be $5,645.86. And let's see if it makes a difference. It probably does not, but an extra 400 is not that bad. But because our cash flow is 5,000, already 5,000, 5645.86. Yeah, it didn't make a difference. Yeah, I think it made the interest a little bit less, but it didn't make a difference in terms of the number of months to pay off that auto loan. So 39 months, paid off the debt. And then this is going to be 167 plus 27. So that's going to be 194K. Yep. And we're at the 12-minute mark, right? 12-minute mark. So now last thing is the mortgage. So there's really two choices when you have to pay off the mortgage. And let's see if there are the two choices right here. So first one is extra payments. And if you don't know what extra payments is, it's relatively easy. It's like kind of the default option of overpaying your loan. You have, let's say, $5,645.86 left over. And then you pay your mortgage. And then you just keep making the payment on the mortgage, but with an extra $5,645.86 on top. So here's a comparison chart of the first option versus the second option. So what's the second option? It's called chunking. So basically what you're doing is you're taking a small amount, so we'll say $10,000, and move it from the loan into the line of credit. So let's just do 10,000 right here. And so what this does is the balance of the loan is going to be subtracted by $10,000, and then we're going to dump all of our cash into the line of credit and see that $10,000 disappear in the line from the line of credit in 2 months, and then we're going to just kind of do it again, and then in 2 months that 10,000 disappears, and then we rinse and repeat over and over again. So now this is what we call chunking, incremental payoff, and if you ever do the math, like they're pretty much the same. Now, here's how I'm just gonna demonstrate this. Okay, I'm actually just gonna rank it based on what's the likelihood you're gonna actually do it. And here's the most important thing about paying off the mortgage is not whether you do extra payments or use a HELOC to pay it off, because you still have, no matter what, you still have to pay the $300,000. Okay, or what was the loan amount? Yeah, $300,000. You still have to pay it, right? But the issue is that nobody pays off their mortgage early, and certainly nobody does in 2 years and 9 months, right? And the reason why most people can't do it with an extra payment, which is a default option, is that they experience too much decision fatigue, because every single month is a negotiation of how much should I pay extra today into that loan. And if you've ever overpaid a loan, had I ever felt that pain, I can't get that money back. There's a reason why most people don't do it, even though technically you can access that money, right? Like if you overpay a mortgage, then just get a second lien HELOC and voila, you somehow have money to use as long as you didn't need it in the first place, okay? But that's how it feels. So there's this perceived risk level of, hey, I if I make an extra payment, it's not the same amount every single month, right? I don't think everybody has a fixed budget. This is why I work on averages and not on super fixed amount. But when you're making the extra payment, you have to really know to the exact penny of how much you're overpaying into the loan, which is why most people don't do it, right? And then the other thing too is that there's a very psychological component of doing an extra payment, because let's say I make an extra $5,000 into that $300,000 loan. Well, now it's 295,000. So going from 300 to 295,000, even though it's actually really good, it doesn't feel like you've made any progress. And that's why you can't keep the momentum going, okay? Whereas if you do a $10,000 chunk, when you make a $5,000 payment, or every the like in 2 months, that $10,000 goes away. That's like a 50% increase or decrease in what feels like your total debt, but it's not. It's only $10,000, and that's why you gain momentum. It's like one of those like brainwashing tricks to kind of trick like children into doing what you want, or I think that's how it works. Okay, so small wins create momentum. So a lot of times, people get freaked out by this method, because you're usually going to have a higher interest rate, a line of credit attacking a loan. Okay, because the loan is 4% and the line of credit is like 8%. And so if you know how the world of like 30-year mortgages works, if you go from 4 to 5 or 5 to 6, just 1 point, the market goes crazy. The housing market goes crazy, because that's a huge difference in terms of the monthly payment. But we don't care about the monthly payment, okay? We care about the order we pay off the debt to increase and maximize our cash flow, okay? And what we're going to do is I'm just going to demonstrate, even with the 8, 15, 30% line of credit, I think we're still good. But let me go ahead and open up the calculator. All right, there we go. So we have this calculator here. We call it the band calculator because we can't use the name it was formerly known as. And then you see here that if we do $10,000 chunks, moving it from a loan to the line of credit, even at 8%, we pay it off in 3.6 years. And so, here's the thing. Even if you use a 15% line of credit, like 1.5, it still pays off in 3.6 years. And then I think it's a 2 grand worth of difference in interest. And then if you use a 30% line of credit, it's like a 5 grand difference from 8%. So yes, interest rate does matter, right? So don't like listen to the hype about, oh, interest rate doesn't matter. Line of credit always better than loan. That's not true. You got to be a little bit careful about that. And I'll tell you what the worst thing you can do is you replace your entire loan with a line of credit. That is no bueno, no bono, no buongiorno, digiorno, right? I don't even know what digiorno is. It's not delivery, but it's digiorno. Yeah. But anyways, yeah. So if you kind of hear me and kind of like, oh, whatever, it's just because like I've been doing this for so long that sometimes it's kind of like, you ever watch those old kung fu movies where there's that master with that white beard, and he just kind of stares into like the abyss, and turns out like, he doesn't look like he's really doing anything. And then like once the time comes to strike, then he's like the super kung fu ninja master. I think I'm there. Actually, probably not. I need a little bit more practice. But yes, we did pay off the debt in 3.7 years. And I'm just going to go here. And so now we're going to mark this as paid, no more mortgage, and then this is going to be 39 divided by 12 plus, what is it? It is 3.7 years. So we are debt free in under 7 years, 6.95 years. 6.95 years, and then we are debt free. We're debt free. Okay? We are debt free. All right. Well, that's it for today, folks. If you made it to the end of this video, if you made it to the end of this video and you want to let me know, write in the comments below 4 touchdowns in one game. 4 touchdowns.
I'm Al Bundy. There's a time I scored 4 touchdowns in one game on this field.